Well, good afternoon, everyone, and welcome to the part 2 of the Pitcher Partners JobKeeper webinar series. Thank you very much for joining us this afternoon. My name is Craig Watman. I'm the GST partner here at Pitcher Partners in Melbourne. I will be taking you through the presentation this afternoon. So moving into the content of the presentation, this is what I would like to cover over the next hour or so. So firstly, a brief overview of who is eligible for the JobKeeper program, how you assess your eligibility, when you assess your eligibility, and then diving into the turnover question, which is the main focus of this presentation today. How do you determine your turnover for JobKeeper purposes? What is projected GST turnover? The differences between turnover and what's reported in your business activity statements, and then just looking at the end about the risks of getting it wrong and the ongoing compliance obligations that are required under the legislation. So just a brief overview, first of all, about the key aspects of the JobKeeper scheme. As I'm sure we're all aware by now, it is a COVID-19 stimulus measure that's estimated to cost around $130 billion over the next 6 months. We need to focus on eligible employers and eligible employees. The JobKeeper payments will be made to eligible employers and non-employer businesses, such as self-employed persons who have the requisite decline in their turnover during the relevant period. The payments will be $1,500 before tax per eligible JobKeeper fortnight for each employee who is employed by that eligible employer. If you haven't already done so, you can register your interest in the JobKeeper scheme on the ATO website using the link that's shown on the slide here. And we understand that employers or their tax agents will be able to enrol from the 20th of April, which is next Monday. So who is eligible? This looks at the decline in turnover test and the relevant thresholds. There are different thresholds for the decline in turnover test depending on the relevant entity that is doing the calculation. So an ACNC registered charity, excluding universities and certain schools, that has its turnover decreased by at least 15% is one category. The second category is an entity that has aggregated turnover of more than $1 billion and its turnover has decreased by at least 50%. And the other category, which applies to all other entities, is where its turnover has decreased by at least 30%. One thing to bear in mind in respect of the 50% threshold is that that aggregated turnover test is not actually a GST turnover test for this purpose. That is an income tax turnover test, which is driven by the Income Tax Assessment Act 1997 and looks at the aggregated turnover of the relevant entity together with the group that it may be part of. So just be aware, for the purpose of assessing whether as a business you might be within the 30% or 50% categories, you do need to look at aggregated income turnover for income tax purposes. And the test does look at both the previous income year as well as the current income year, which can involve a projection for the remaining of the year to determine whether you will exceed that $1 billion threshold. So how do you test a decline in turnover? Well, there's two ways that an entity may satisfy the decline in turnover test for JobKeeper eligibility purposes. There's the basic test and the alternative test, and I'll talk to each of those now. So under the basic test, it requires a comparison between what's called the test period and a comparison period. The test period must be a calendar month that ends after 30 March 2020 and before 1 October 2020, or a quarter that starts on 1 April or 1 July. The comparison period must be the period in 2019 that corresponds to the test period. So for example, if your test period that you have chosen is the month of April 2020, you are required to compare that with the equivalent month, April in 2019. Importantly, the employer entity can choose an eligible month or quarter as their test period, irrespective of whether they lodge their BAS monthly or quarterly. So it doesn't matter whether you are a monthly or quarterly BAS lodger under the legislation. You do have the option of choosing either a monthly or quarterly test period. The test is done up front, and it's only done once for the purposes of determining whether you meet the decline in turnover test. So it's not an ongoing test that needs to be made each month or each quarter. And importantly, you'll notice there that the calendar month test refers to a calendar month that ends after 30 March 2020. Our understanding of that is that there is an entitlement to use the month of March as the relevant test period, given that March ended on the 31st of March. The difference between using March and any subsequent period obviously is that March is already finished, and therefore instead of having to project your turnover for part of the relevant month or part of the relevant quarter, you can actually use actual figures. Now, it will of course depend what happened in March in respect of your business and how that business might have been impacted for the month of March. But if you saw a sufficient decline in turnover during the month of March, which may enable you to meet the decline in turnover threshold, then I would suggest you have a look at potentially using March as the relevant test month. So that was the basic test. There is also an alternative test. It's set out in the legislation, and it allows the Commissioner to determine an alternative test for a class of entities by way of a legislative instrument, and take other factors into account for individual entities. So some of the circumstances that are referred to in the legislation and the accompanying guidance that has been released by the government, where a business might not have been in operation a year earlier, and therefore obviously it's impossible to have a comparison period in 2019 that is compared to the 2020 test period. Another example is where the turnover for the prior year may not be representative of that entity's usual or average turnover because, for example, of the drought, the bushfires, or the fact that their turnover is typically highly variable. So the Commissioner has a discretion to consider additional information that the business can provide to establish whether they have been adversely affected by COVID-19. At the moment, our understanding is that the ATO is in the process of preparing the legislative determinations that will be issued for specific classes of entities. We've obviously had a number of questions on this issue to date about how particular classes of entities are impacted by these rules and how they should be calculating their turnover in the relevant periods. One of those classes is service entities, which is a common structure whereby you have a service entity within a group that is the employer of the relevant staff and then charges service fees to a range of other entities within the group. Obviously, that's different from a normal trading business in the way that you would calculate turnover. And our expectation is at this stage is that there should be a legislative instrument issued, we hope, next week that will cover class entities as well as some of the other circumstances that are referred to on this slide. So please keep an eye out for that. We do expect some further information coming out on that next week. So how do you calculate your turnover? The first concept that we need to deal with is projected GST turnover. So projected GST turnover is defined in the GST Act, and it is the sum of the value of all supplies an entity has made or is likely to make during the relevant period. Now, the value is the GST exclusive value. So that is the defined term for GST purposes. When you're looking at value, you are looking at the GST exclusive value of the relevant supply. And we've received a number of questions about, well, what about if you're not actually registered at all for GST purposes, which is a very interesting one in the sense that the JobKeeper scheme does not actually require you to be GST registered in order to access the scheme, despite the fact that the entire legislation in terms of the turnover calculations is geared towards the GST Act, and I guess works on an assumption that the relevant entity will be within the GST system. But it appears that you can still access the JobKeeper scheme, for example, if you are a small business that is below the $75,000 registration turnover threshold, or you're a charity, for example, or other not-for-profit that is below the $150,000 GST registration turnover threshold. Our assumption is that the ATO will issue some guidelines on that issue, and our expectation is that effectively those entities will be required to calculate their turnover as if they were a GST registered entity, using the same principles that a GST registered entity would use, despite the fact that they're not currently in the GST system. But once again, please keep a watch out for that. We hope that there will be some guidance on that issue coming out. So the relevant period for JobKeeper purposes is the test period in terms of projected GST turnover, which is, as I said previously, is the chosen month or quarter. So normally projected GST turnover is a 12-month concept, but here it's been modified for JobKeeper purposes to be the relevant month or quarter that is being tested for the purposes of the decline in turnover threshold. So what do you include within projected GST turnover? You need to include any taxable supplies that have been made in that period, any GST-free supplies that have been made in that period. What you don't include, however, are input tax supplies. So input tax supplies are specifically excluded from the definition of projected GST turnover, and they include things such as residential rents and any income from financial supplies such as interest on a loan, etc. You should also exclude any supplies for nil consideration, provided that they are not taxable under the associate rules, and I'll talk a little bit more about that later. You should also exclude supplies that are not connected with your enterprise, so that may include supplies of private assets outside of the enterprise that you're carrying on, as well as supplies that are not connected with Australia. The JobKeeper rules have made some special modifications to the rules in the GST Act regarding projected GST turnover. As I said before, the first modification is that the relevant period to be considered is the month or quarter test period and the corresponding comparison period in 2019. Importantly, supplies between members of the same GST group are included for JobKeeper turnover purposes. So normally a registered GST group would prepare and lodge its BAS on the basis that it is a group, and supplies between members of the GST group would be ignored for GST purposes and would not be reported within the business activity statement that's lodged by the representative member of the GST group. But that's different for JobKeeper purposes. For whatever reason, the government has decided that the GST turnover must be considered on an individual entity basis, even for entities that are members of a GST group. Each external territory of Australia is also treated as forming part of the indirect tax zone, or Australia for GST purposes. There are also special rules for ACNC registered charities, including those that are deductible gift recipients. So for an entity that is a DGR, or deductible gift recipient, each gift that's described in section 30-15 of the Income Tax Assessment Act and that is received or likely to be received needs to be treated as consideration for a supply, and the value of that gift, being the amount of the gift, needs to be included as part of the DGR's turnover for the relevant periods. Other registered charities that are not GGRs must also include gifts received or likely to be received by way of monetary donation, any gifts of property with a value greater than $5,000, and any listed Australian shares that are gifted to them. They all must be included within the relevant turnover for the purposes of calculating the decline in turnover test. So what is the value of supplies? As I said, it is a defined term for GST purposes, and it does equal the GST exclusive consideration received in relation to a supply. So it is possible for entities that are within the GST system to actually report on a GST inclusive basis in respect of their business activity statement lodgements. But for JobKeeper GST turnover purposes, we must be looking at the value of the relevant supplies, which is the GST exclusive consideration, not the GST inclusive consideration, which raises the first very important point that you should not simply be relying on what has been reported in your business activity statement for the purposes of undertaking these turnover calculations for JobKeeper. It is necessary that to look beyond the BAS, and it's a clear fact that the value of all supplies that an entity has made will not necessarily be equivalent to the amount that's been reported at label G1 of their business activity statement. There are a number of different ways that business activity statements are put together by a whole range of different entities. A lot of that is just historical, and in the past, it really hasn't made any difference because the net GST position has not been affected. But for JobKeeper turnover purposes, it will become very important the way that you have put your BAS together. And my assumption is that in a large number of cases, the figures that have been reported on the BAS will not be representative of the relevant values that need to be included for turnover purposes. So that is the first watch out. Please don't assume that you can just rely on the BAS for the purpose of undertaking your turnover calculations. So I'd like to just move into a checklist of some of the issues that we believe you need to consider when calculating your GST turnover for JobKeeper purposes. The first one is in relation to margin scheme supplies. So for any of the residential property developers online today, if you have been preparing your business activity statement correctly, the ATO requires you to include at G1 the margin in respect of the relevant supply of residential property. So only the margin that arises under the margin scheme is the amount that should be reported at label G1 of the BAS for supplies of apartments and other new residential premises. However, that margin is not the full value of the supply for GST purposes. The full value of the supply is the full sales price, excluding the GST component. So just to watch out for margin scheme developers. If you have been doing the right thing, which is only including the margin in your BAS, you will need to adjust that to account for the full value of the supply. GST groups we've already mentioned, but just to emphasize that, the rules require each member of the GST group to look at their turnover on an individual basis, not on a GST group basis, which means that despite the fact the BAS will have ignored any supplies being made between the members of the group, those transactions effectively need to be accounted for the turnover calculation. So it will be necessary to go behind the BAS, behind the group calculation, and focus on any transactions that have been made, any supplies between the members of the group, which do need to be included if they are taxable or GST-free supplies. Associates is another one. So the general rule is that supplies for nil consideration don't need to be included as part of turnover. However, if those supplies are between associates and the recipient of the supply would not be entitled to a full input tax credit if GST were payable, or the recipient of the supply is not registered for GST, there are special deeming rules in the GST Act which require those supplies to be treated as taxable supplies based on the market value of the supply being made. So irrespective of the fact of whether the associates have agreed to pay consideration between themselves, it will be necessary to look behind those transactions and determine whether there is a market value substitution rule that will apply for turnover purposes. Out of scope income includes things that are usually excluded from the BAS but would need to be included for JobKeeper purposes. So the main one of those is for the charities, which relates to the donations. Normally donations would not form part of GST turnover, but they will form part for the purposes of the JobKeeper provisions. Most insurance settlements are not subject to GST and would therefore need to be excluded from the BAS. And as I said up front, any input tax supplies such as residential rentals, financial supplies, supplies made by retirement villages of residential accommodation and other residential accommodation should all be excluded from the turnover calculation if they are input taxed. So despite the fact that the turnover eligibility test, the decline in turnover test, only needs to be undertaken once in respect of the test period, it is our recommendation that entities continue to assess their turnover on an ongoing basis through the course of this scheme. And there's a couple of reasons for that. One is that, first of all, there is a reporting obligation, which I'll get to a bit later, that effectively requires you to keep account of your turnover on an ongoing basis. And the second is just to ensure that you pick up any significant anomalies as you go along that may have impacted your eligibility for the scheme in the first place. And obviously there are risks associated with determining eligibility on a self-assessment basis, with the ATO then coming in and determining otherwise in the course of a GST review or a JobKeeper review, either during this scheme or post the completion of the scheme. So it is our recommendation that you continue to assess your turnover and do the turnover calculations on a monthly or quarterly basis. The other issues that I wanted to cover off on in terms of the GST turnover calculation are GST-free supplies. So they are required to be included within GST turnover. Often what happens in terms of the preparation of a BAS for entities that do make GST-free supplies is that those supplies can just be left off the BAS altogether because they don't have any GST impact. However, they will become important. They are important for the purposes of assessing the decline in turnover test, and therefore, if they haven't been dealt with correctly in the past for BAS reporting purposes, once again, you will need to go behind the BAS and identify those GST-free supplies. Barter transactions are another common one where there's no monetary consideration that changes hands, but there could be an exchange of promises or goods, etc. Those are supplies for GST purposes between each entity, and they do need to be accounted for. Private assets which are sold outside of the enterprise being carried on should be excluded. Also, supplies made as agent of another entity should also be excluded. So if your role is to act as an agent of another entity and to make supplies on their behalf, then the turnover from those supplies outside of a special deeming provision is the turnover of the principal, not the turnover of the agent, and therefore the agent should not be including that income within its turnover. The only income that the agent should really be including is any agency service fees that it charges to the principal for its conduct as an agent. And a difficult one is the concept of incorrectly registered entities. So it's not uncommon for us to see, for example, trustees of trusts that have been registered in their own right as trustees rather than a registration occurring for the trust, or partners in partnerships where a partnership hasn't been registered as required under the GST Act, and the partners are just dealing with the GST on their individual accounts. That is something that you will need to consider if you fit within any of those entities, because a starting point of these rules assumes that you have actually got the correct entity registered for GST purposes. And if you haven't, then it's going to be very difficult for that entity to actually satisfy the relevant tests in the legislation. So just to give an example of that, here we have BizCo 1 and BizCo 2. They jointly own a commercial rental property. They have a joint bank account, and there is an agent that manages their property on their behalf. they haven't registered a partnership, they don't lodge a partnership return. Instead, each entity includes 50% of the value of each rental payment as a taxable supply within their own separate business activity statement. Now, obviously, you would need to examine the detail of this before making a decision, but it's reasonably likely that that type of structure is likely to constitute a partnership for tax and GST purposes, which means that if that is the case, those entities should have registered a partnership entity and have been incorrectly reporting the relevant supplies and acquisitions in their own business activity statements as opposed to a partnership registration. So the impact of that is that those JV entities, if they separately assess their own eligibility for the JobKeeper scheme, may not in fact get off base one because they won't satisfy the relevant test of carrying on an enterprise in their own right, and they won't be able to actually determine an appropriate decline in turnover unless they have the right GST registration. Cash versus accruals is another very common question that we've been getting over recent days and weeks. And once again, there's no complete answer to this, unfortunately, but it is a very significant issue. Obviously, there are a large number of cash basis accounting entities, both or inside the GST system, that report their GST obligations on a cash basis. So the difference is that under cash basis accounting, the timing of when payments are reported on the BAS is obviously driven by when the payment is received, not when the invoices are issued. Whereas accruals accounting taxpayers, the timing of when their amounts are reported on the BAS is driven by when their invoices are issued, unless of course they receive any payments first. So there's a critical distinction in terms of the timing of amounts that may have been reported on the BAS between cash basis accounting taxpayers versus accruals accounting taxpayers. And the issue that arises then is if you are a cash basis accounting taxpayer, how should you be calculating your turnover for the purposes of the decline in turnover test? Should you be looking at the cash receipts as per your BAS lodgement, or should you be looking at invoices that you have issued? The difficulty arises because the projected GST turnover rules within the Act actually talk about supplies that are made during the relevant period. They don't account for situations necessarily where you are on a cash basis and you're accounting for payments received rather than accounting on the basis of invoices issued. We are expecting ATO guidance on this issue, and I am hopeful that the ATO will come out and effectively allow cash basis accounting taxpayers to calculate their turnover on a cash basis by effectively doing what they've done in their BAS, which is looking at actual receipts rather than having to get behind that and turn it into an accruals basis calculation for JobKeeper purposes. But at the present time, that issue is not clear in the legislation, so it does require ATO guidance, and we are expecting some guidance on that hopefully in the near future. So just to give an example on the other side of that coin as to how that might impact, we've got Tradeco that is under the $10 million threshold and accounts for GST on a cash basis. Tradeco chooses April 2020 as its test period for JobKeeper turnover purposes. In April 2020, it expects $300,000 worth of sales to be invoiced, and it also expects $290,000 worth of collections to be made in respect of sales that have been made in prior quarters. So when it compares that to the relevant comparison period, which is the month of April 2019, it sees that there were $500,000 worth of sales invoiced in April 2019 and $300,000 worth of cash collected for prior months' sales. So it's critical for Tradeco here to determine how it's going to approach its GST turnover calculation. You can see from those figures by doing some quick maths that if Tradeco were to adopt an accruals basis calculation test, it would have seen a 40% decline in turnover based on the invoice sales between April 20 and April 19. However, if it does the test on a cash basis, then it has suffered a less than 5% decline, at least for the month of April, in respect of its cash collections. So despite the fact that I just said I'm hopeful the ATO comes out and allows cash basis accounting taxpayers to effectively do the calculations as they have done their BAS, which is on a cash basis, the other side of that coin is that in examples like this, entities such as Tradeco may actually have to wait until future months, May, June, etc., to see a further decline in cash collections in order to satisfy the requisite 30% decline in turnover test, for example. Because based on their sales, if their sales have held up, based on their sales, they may well have exceeded the relevant threshold, as can be seen in this example, but those sales on an invoice basis may not be relevant for the purposes of the test. So we will have to wait for guidance from the ATO on that, and as I said, there are a large number of entities that are waiting with bated breath for that guidance to determine how they should be calculating their GST turnover. Adjustments is the next issue I just wanted to cover, and this is an important issue, particularly in the context of the current environment where a number of businesses will be suffering in respect of bad debts, but potentially in terms of having to offer discounts to their customers for the goods and services that they have supplied. So the relevance of adjustments is that an adjustment event can cancel a supply or change the consideration for a supply. It does depend on the timing in which the adjustment occurs, because adjustments or adjustment events can arise in either the same period that the supply has occurred, or perhaps more commonly can arise in a later period. Adjustment events can also affect GST-free supplies. So even though you don't have any GST impact, you can technically have an adjustment event in terms of, for example, a reduction in the value of the supply that's offered by way of a discount, a credit note, etc. So the importance of all of that for the purposes of determining your decline in turnover test is that our view on credits and discounts, etc., is that they do affect the value of the supply that has been made. So just to give you a basic example, if you've issued an invoice for $110, including GST in period 1, and then a couple of months go by and we're getting further into the COVID-19 period, and you decide that in order to receive some of that amount from your customer, you need to issue them with a credit note for $44, including GST, and that's in period 3. So period 1, you've issued an invoice for the full amount, 110 including GST, and then in period 3, you issue a credit note for $44 including GST, possibly based on a discussion with the customer that that's all they can afford to pay and you'd rather have the balance as cash in your pocket. So the outcome of that effectively is that the credit note of $44 including GST has adjusted the consideration for the original supply. So the consideration excluding GST was $100. It's now been reduced by $40. So the value of that supply after the credit note is now $60. Now, when you're looking at comparison periods in 2019, for example, and also potentially test periods, it is important to bear in mind that where you are issuing credit notes and providing discounts, then they do have an impact on the value of supplies that have been made in previous periods, and therefore you do have to look at that impact in the course of determining what your relevant GST turnover was, for example, in the 2019 comparison period. You can't simply ignore the adjustment note, the credit note that's been issued, and not worry about that. There is, however, a critical difference between discounts and credits versus bad debts. So the GST legislation does allow for a bad debt adjustment where a debt has either been written off by the supplier as bad or it has been outstanding for more than 12 months. So by writing off that debt, the supplier does get effectively a GST credit equivalent to the amount of GST that's been remitted on that supply. But the bad debt adjustment rules do not tie into the value of the supply. By writing off a bad debt, you don't actually decrease the value of the original supply that's been made. If the debt was for $110 including GST and you write that debt off, the value of the original supply is still $110 including GST. Yes, you get the benefit of a bad debt adjustment, but technically, if you work through the legislation, it doesn't impact the value of the original supply. So that is an important difference between credits, discounts versus bad debts, and one that you will need to take into account when you are assessing your turnover for the relevant period. But just looking at another example in terms of test period versus comparable periods, we've got Service Co that invoices its clients on a weekly basis each Thursday. It has decided to use the month of April 2020 as its test period, which therefore means that April 19 is the relevant comparison period. So in April 19, there were 4 Thursdays in the month, and Service Co invoiced $100,000 each Thursday to its clients during that month. In April 2020, however, there are 5 Thursdays in the month, and Service Co has invoiced $70,000 each Thursday of that month. So the sales based on the invoices issued would have been $400,000 in April 19, and the expected sales in April 2020 based on the projected GST turnover calculation will be $350,000. So that represents a decline in turnover of only 12.5%. But the question is that the correct result for the purposes of the decline in turnover test? And I'm sure I can't hear you, but a number of you will be saying, no, that's absolutely not the correct fair result in those circumstances. And I completely agree on a fairness basis. The difficulty is that the legislation just doesn't effectively deal with that kind of circumstance. So we then need to look at the options. So what about if Service Co decided to delay its 30 April 2020 invoice to 1st of May so that it effectively only issued 4 lots of invoices in April 2020 and could then compare that to the 4 lots of invoices that were issued 1 year earlier? Now, I think that's definitely an option for consideration, but what we also need to take into account here is there are very strict integrity rules that have been inserted within the legislation and which the tax office will no doubt be relying on when it assesses whether relevant entities that have received JobKeeper payments were entitled to those payments and actually satisfied the relevant decline in turnover tests. So we need to keep that in the back of our mind, that there are integrity, if you like, anti-avoidance rules within the legislation. But if you look at this on a fairness basis and on a basis of assessing what should be the right result, then one may well get to the conclusion that it would be acceptable for Service Co just to delay that invoice at the end of April to the 1st of May in order to achieve a like-for-like comparison between the test period and the comparison period. So projected GST turnover does require you to make an estimate of turnover. So for example, if you choose the month of April 2020 as your test period, and we're currently sitting at the 17th of April, if you were to do your decline in turnover test calculation today, that would have 2 parts for the current month. The first part would be the actual turnover that you've derived between 1 April and the 16th of April, being yesterday. And the second part would be the expected turnover that you expect to derive between today and the end of the month. And together, those 2 amounts form the projected GST turnover for the relevant period, being the month of April. So how do you estimate your turnover for the remainder of April? Effectively, you're required on a balance of to look at a balance of probabilities. So on the balance of probabilities, a supply will likely to be made if it can be predicted that the supply is more likely than not to be made. Now that's a bit of a mouthful, but effectively you've got to make an objective assessment of your prospects as a business based on a reasonable person test of actually deriving that turnover that you're going to include in your calculation for the period between today and the end of the month. Now that test needs to take into account any business plans and budgets that you've got in place. So you can't have a budget that has been consistent for every year and you've adjusted for COVID-19 and then suddenly decide for the purposes of projected GST turnover that you're going to reduce that budget by 50% without explanation. Now there may well be explanation for that, and it may well be able to be supported based on the moving landscape of COVID-19, and things are obviously changing every day, but you need to be careful about that. So you need to look at historical information, you need to look at what your forecasts are as well, you need to look at your existing and prospective contracts with your customers in order to determine whether on a balance of probabilities it can be predicted that the relevant supplies you're going to include for the rest of the month are more likely than not to be made. So the risk of getting it wrong is something that we unfortunately do need to consider. And if we just look at this example here, we've got an entity that once again has chosen the month of April 2020 as its test period. It is therefore looking at its projected GST turnover for the current month. It's determined that that will be $600,000. In the equivalent period last year, its turnover was $1 million. What happens if we get to May and that entity determines that its actual GST turnover for the month of April turns out to be $720,000 instead of the projected $600,000? Does the entity still satisfy the basic decline in turnover test, and is it eligible for the JobKeeper payment from April onwards? Well, the basic answer is that yes, it does satisfy the basic decline in turnover test, subject to having done all of the right things and identified its turnover correctly both in April 20 and April 19, and subject to what I just said about doing its projected GST turnover based on a reasonable person and based on the tests that were outlined in the previous slide. So even if it turns out that the actual turnover for the month of April is higher than the estimated turnover under the projected GST turnover calculation, that should technically not affect that entity's ability to access the JobKeeper payments from the month of April in respect of each eligible fortnight. But what happens, for example, if the actual turnover turns out to be $900,000 instead of $600,000? Once again, technically the answer is the same as long as it did the calculation in the right way in terms of its projected GST turnover. But you can obviously see the fact that the risk is going to increase as the actual turnover increases. And you may well expect that if the ATO has a look at that situation and sees actual turnover of $900,000 for May, which will need to be reported, and compares that to the $600,000 of projected turnover that was used for the calculation purposes, then it might start asking some questions about how that calculation was done for projected GST turnover. That potentially then gives rise that if the ATO determines the calculation was done incorrectly, that we do have an overpayment debt risk, which is basically that the employer has received the JobKeeper payments without being eligible for those payments. It is then at risk of having to repay those payments, even though they would have obviously been passed on to the eligible employees in the sense of the $1,500 per fortnight. And it's then exposed not only to that repayment of the main amount of the payment, but also penalties and interest. So I guess the bottom line of all of that is that it's very critical to go through a complete and proper and reasonable process in terms of assessing your projected GST turnover. And right at the commencement of this seminar, I did mention that based on the legislation, it does appear that the month of March, which is already finished, is an option for the turnover test period. So if that option is available to you, and if it does give rise to your business or other entity exceeding the relevant threshold for the decline in turnover, then I would suggest that you consider that, given that it does lessen the risk of getting this wrong. So as part of that same theme, it is obviously very important to keep supporting documents as part of the JobKeeper scheme, not only in terms of general eligibility, but specifically in relation to the calculation of GST turnover and the calculation of the decline in turnover between the test period and the comparison period. Evidence establishing how projected GST turnover was calculated, particularly if we're doing it now in the middle of April, for example, will be crucial to supporting the entity's eligibility for the payments, and will be crucial to supporting the entity's case in the event of an ATO review. And I think I always like to start from the assumption that there will be an ATO review and work backwards from there. And I think if you start from that assumption and work on the basis that you need to put yourself in a position and put your business in a position whereby you're ready to answer questions when the ATO knocks on the door about how you did your relevant calculations, then you'll be in a good place. So that means looking at your business plans, that means looking at your budgets. As I said, that means looking at current and future contracts, and very importantly, it means documenting absolutely the steps that you've gone through in calculating your GST turnover, how you've done a comparison between the figures reported in your BAS and any adjustments that need to be made to those figures to get to the correct value for GST purposes, how then you've calculated the relevant decline, be it 15, 30 or 50%, and make sure you've stepped that out thoroughly in a way that you'd be happy to present that to an ATO officer when they knock on the door. Or in the current environment, don't knock on the door, but call you up and ask for some evidence of your eligibility. So in terms of the ongoing compliance obligations under the legislation, there are some that we need to be aware of. So each entity that is within the JobKeeper scheme must report its current GST turnover for both the reporting month and its projected GST turnover for the following month to the ATO within 7 days of the end of each calendar month. So this has been set out as an administrative requirement only in the sense of the legislation, and in the sense that, as I said before, the decline in turnover test is a once-off test that needs to be performed at a point in time, taking into account the chosen test period and the comparison period. There's no requirement to continue assessing eligibility on an ongoing basis throughout the 6 months of the JobKeeper scheme, but there is a requirement following the end of each calendar month to send a report to the ATO, which they'll no doubt issue some further guidance on shortly, which does include your current GST turnover for the month that's just finished, as well as your projected GST turnover for the current month that you're in when you do the reporting. The ATO or the government has said that the reason for that reporting obligation is not about eligibility, it's about giving the government the relevant information that it needs to assess the true economic impact of COVID-19 on businesses and other entities such as charities. And while that makes complete sense, it will be obvious to all of you that that does present a fair bit of information to the tax office, and no doubt, excuse me, that information will be scrutinised, potentially for the purposes of looking at trends, comparing those figures to prior years, taking into account expected declines during the current period, comparing it month by month or quarter by quarter, comparing it to the relevant turnover test that would have been used for assessing eligibility, and then working out whether further action is required in terms of follow-up by the ATO to review not only the compliance with that requirement, but the initial eligibility for the scheme. So while it's not being presented as an issue in relation to eligibility, it is our strong recommendation that you do ensure what is reported to the ATO is accurate on an ongoing basis, not only in the test period, but throughout the scheme, as those reported figures could be used by the tax office in post-scheme reviews of your business. So I mentioned earlier that in our view, it's very important you don't just rely on your lodged BAS at face value, because there will be a number of adjustments, and I think this will be the case in almost every case for a GST registered entity, that the figures that have been reported in the BAS for the comparison period in 2019, for example, will not 100% reflect the correct GST turnover for the decline in turnover test calculation. So it's our recommendation that you do need to get behind the BAS, and we've set out on this slide a bit of a process that you might go through for doing that. And I won't go through that in detail, other than to say that we believe you do need to spend the time to actually, first of all, look at the BAS, but then go behind the BAS into the detailed reports, into the financial reports, in order to make a comparison, taking into account all of the potential adjustments that may be required to account for things that may not have been reported on the BAS, such as GST-free supplies, to account for incorrect values in the BAS, such as sales of apartments under the margin scheme, to account for input tax supplies that may have been incorrectly included in the BAS, to account for adjustments by way of credit note or discount that then change the value of the supplies in the comparison period. So I do strongly recommend that you go through this process, or a process similar to this, in terms of determining not only your GST turnover for the test period and the relevant comparison period, but also on an ongoing basis for the purpose of the monthly reporting that you will be required to undertake for the ATO's purposes. So that takes us to the end of this presentation. We do appreciate your attendance today. If you do have any further questions, feel free to submit them, and there's also some contact details on this slide for the members of our GST team. So thank you everyone, appreciate your attendance, and enjoy the rest of your afternoon. Thank you.